Hello, everyone. Welcome back to another episode of Policy and Profits. I'm Anthony Esposito from Island Capital Investments. I'm joined by E.J. Antoni, our economist extraordinaire. How are you today, E.J.?
Anthony, I am hanging in. Always a pleasure to be joined by our investment extraordinaire. So thank you for having me again, sir.
Wow. Thank you. Winning at life, as I like to say. We have a couple of really interesting things to get into today, one of which, not the least of which, but will be the end of the show or the last half of the show, is the report that you issued with the Brownstone Institute. It's absolutely phenomenal look at where we are as far as real growth, where we are as far as real inflation, and what all of the numbers that we're looking at each day actually mean for the individual households in this country. So I want to get to that. First, I want to look at CPI. We had a couple of things out. We had the minutes from the FOMC meeting from the 18th out yesterday, and then CPI out today. CPI came in a little hot. We had year over year at 2.4%. Expectation was 2.3%. Year over year, ex food and energy, because who consumes food and energy, up 3.3% versus 3.2%. And then kind of the kicker that really was the curveball was the initial jobless claims came in also hot at 258,000 versus 230,000. So as we look at the numbers coming in, it's kind of what we have been talking about, where inflation has not been tamed. We're not even at the 2% target. And by the way, listening to Kudlow earlier today, didn't even realize we're actually running at 3 years above the Fed's target. So then the question that we beg to ask is, well, why did we cut 50 basis points heading into an election when we're 3 years away from being at our target and not there? So we have inflation, which looks like it's sticky and hasn't come down to target. And we have a problem with the quality of jobs, which we've gone through. And now just the initial jobless claims look hot. Where do you think we're at with this, and what do you think the next steps are? What's the trajectory here?
Well, Anthony, one of the really interesting puzzles, I guess we could call it, with the jobless claims has been how the increase in the number of people getting laid off has not translated for the better part of 2 years now into higher jobless claims. So we've only had a couple of times, for example, that we've broken over this 250K mark, which we just got over again today. So it is really, really strange. I've heard a couple of explanations for it, but none of them can account, even if you put all of them together, I should say, they don't all together account for this huge disparity between the number of businesses that are reporting layoffs and the size of those layoffs and the very low number of claims. One example of kind of an explanation here is that an increasing number of people who have gotten jobs lately have been foreigners. These are foreign-born workers. These are people who are not going to be eligible for unemployment insurance, even if they're here, legally, whatever the case may be. They still can't get UI benefits, and so as those folks get laid off, they've been a disproportionate number of hires. Now they're a disproportionate number of the fires. Unfortunately for them, they are not eligible for UI benefits, so they're not filing. That explains a relatively small portion of the disparity, but again, nowhere near all of it. So now the question is, okay, are the numbers actually just becoming more reflective of reality, of what's really going on? Or are we genuinely seeing an uptick in the number of not just claims, but the number of people losing jobs? And unfortunately, the data just haven't become reliable enough for us to be able to right now distinguish between those two.
Have you seen, and just before moving on, and that's a good point, the reliability of the data? Do you see a skew over the past few years? Not to get political at the moment, but it seems to me, I've been doing this for a long time. I started trading in 1996 on the floor of the exchange, and this has been a part of my day, week, month, and year since then. I don't remember the data seemingly so skewed or so off or unreliable as now. Am I wrong in saying that? Has this always been inefficient and skewed, or does it seem like it's getting exponentially worse over the past few years?
No, Anthony, it definitely seems like it's getting much worse as time goes on, because the post-pandemic economy has just become very different from what it was previously. And it's in the same way that so many financial firms, when they were trying to price mortgage-backed securities in 2004, 2005, and they had models based on things like a 20% down payment. right? Based on certain FICO scores, based on certain loan sizes to income ratios, whatever the case may be. All of those models got completely thrown out the window when we decided to all but force banks to make loans to people who couldn't pay them back. And that was a big reason why banks had to come up with all these incredibly creative, using that word loosely, creative mortgages to basically get certain demographics into homes in order to not get penalized by federal regulators. And so, now if you're a rating agency, you're an NRSRO, and you look at some of these blocks of mortgages, you use the same models that worked for 50 years. They don't mean squat today. And the result was AAA rated MBS that was absolute hot garbage. So why am I saying all this? Because today we have a labor market that is very, very different from what it was at the end of 2019. The gig economy has absolutely exploded today. You have this huge number of business startups, for example, that are just sole proprietorships that before you never had. You did have some sole proprietorships, but you could always assume that if we're going to create this many businesses in an economy, you're going to create that many jobs, because each of those businesses on average is going to employ a certain number of people. Today, that number is way down. And so now all of a sudden, we've added all these businesses. The Bureau of Labor Statistics assumes that means we've added a certain number of jobs, and the number is way, way off. I mean, that's just one example of how our statistics just don't fit, or I should say the models don't fit today. And so the statistics that those models produce just are increasingly unreliable.
So how does this reconcile itself? I mean, I constantly on the investment side, I'm trying to figure out how to realize a trade idea I have or something I see. And then I always want things to tie in. I want at the end of the day, at the end of the process, at the end of the trade, I want it to meet. I want to know where it's going to meet and how it's going to tie together and what that profit and loss looks like and what that risk looks like. How does this reconcile itself? Does it just blow up at some point where, I don't know if we're totally off in inflation, we're totally off in initial jobless claims and employment. Does it become, something that ekes back around the rear view mirror in consumer spending, where now all of a sudden consumer spending falls off a cliff, and 6 months out, the economists and the pundits will say, oh yeah, that happened because we actually didn't create all these jobs, and these people actually were underwater because inflation was actually at 15% and not 2.3%. Like, what are your ideas on how this could actually reconcile itself? What's the end? How does this come out of the wash, basically?
Well, Anthony, I think what the question you're asking, if I may, it highlights how problematic it is that this data has become so reliable. Major decision makers, whether that's somebody in Congress or somebody at the Fed or someone like yourself trying to invest yours and other people's money, you're having to increasingly rely on data that doesn't make sense. And so you can't rely on it. Now you have to do your own research, and you have to dig through things like proprietary data sets and try to find the truth. So it's a huge problem. And frankly, organizations, parts of the government like the Bureau of Economic Analysis or the Bureau of Labor Statistics, at this point, given how long these problems have been evident for, I think they owe Congress and really the American people an explanation as to why they have done nothing, even though it has been clear that these problems were evident in the data. All right, so how does this come out in the wash? I think we had a really good example of this, a few weeks ago when we talked about how the Labor Department had to adjust down the number of jobs over a 12-year period by over 800,000. It was 818,000, if I remember correctly. So eventually these things are going to snap back to reality, hopefully, as better data comes in. You get into some really problematic scenarios, though, like we saw in the most recent GDP report, which included not only an update to the latest quarter, but it also included the annual update, which goes back 5 years and revises 5 years worth of data. And what we saw there was, instead of GDP moving down, gross domestic product moving down to gross domestic income, which is what a lot of people expected, instead gross domestic income shot up by over $500 billion. Why? Well, because the Commerce Department apparently just magically found $500 billion of savings that we didn't know existed before. I mean, give me a break. This is all because they changed how a model functions in order to get GDI to more closely align with GDP. So you're basically working under the assumption that one of those metrics is more accurate than the other without any explanation as to why you chose one over the other. I mean, it's absolutely ludicrous, but that's where we are today.
Yeah. Yeah. It kind of, Bostic was out today, speaking for the Fed on behalf of the Fed. And he started talking about, along those lines, he started talking about potentially the Fed now can be patient and potentially not having two cuts in the two remaining meetings for the year. So, it reminds me of that backtrack where I hate to say they're they don't know what they're doing, but they seem to be less data dependent, a little more political than we'd like, and kind of playing it by ear to some degree. I mean, for us to be 2 or 3 weeks out from a 50 basis point cut, expecting two more cuts at the end of the year, that's going to bring us to 100 basis points, maybe 125 basis points, depending. And now for him to be out saying, "Hey, we might not even cut in November, and we can afford to be patient at this point." That walk back to me is kind of like you're not really sure what's going on. It's almost like goes along with the Fed minutes, where, and I'm going to spin for a second. Powell on the 18th of September came out and said, "Hey, this was unanimous, and we made a decision, and 50 basis points is where we wanted to be." And now the minutes come out. And it wasn't as unanimous as you said. And there was a little bit more back and forth. And there was a little bit more push by Mr. Powell to say, it's 50 basis points. I'm heading out to the podium. Now, does anyone have my coffee? Like, that's kind of what it seems like. And now Bostic's like that little, they're playing street ball, manhole to manhole cover or light post to light post. And he's screaming at Powell, hold on, you started off sides. That's not a touchdown. You got to come back. I want to do over. It just doesn't make sense. It's actually... There was actually a note out from France today, which they are cutting, and we can put that visual up now. It's the same type of thing. They've been in this spend mode, this inflationary mode, and they're actually now announcing for 2025 a cut of or a plan to reduce spending by 60 billion euros. Right. So what are they going to do? They're going to tax companies. They're going to tax households, and then they're going to reduce spending across the board at the federal, the state, and the local level. It's just, we've gone down this rabbit hole, we've spiraled, and now it seems like everybody's trying to pull back, or there's starting to be, I'll say, like a canary in the coal mine, where this type of report from France is, we went the wrong way, we're too far. The comment from Bostic today was pretty impressive, because he's calling back a decision that they just made 3 weeks ago. And Powell just a few days ago was up kind of, pounding the table and reiterating the stance that they have as a group, and it's not their stance. The market was actually pretty strong this morning, and testing on the front month futures 58.50 on the S&P futures, and it was a strong move up. It looked like we were going to break out and continue higher, and these comments actually brought us back down into the support resistance channel that we've been in. So it definitely meant something, and it definitely affected the market psyche. Not to say that the market is the end all, and the market will do what it does. But when you hear these conflicting comments back and forth from the Fed, who we're supposed to be relying on for accuracy, relying on for expertise, and Mr. Powell is going to navigate the soft landing, which has never been navigated before. It was a big deal for me to hear those comments coming from him, and the market participants noticed. To shift over to the market, and kind of away from the economics for a second, and then I want to really get into your report. I'll put up a clip right now of the S&P and where we are. We've been working through a range of the 56.86 support, 57.33 around mid of that range, and then 57.60 has been upper level support. So what I did basically here is, as we came out of the 18th FOMC 50 basis point cut, the 19th high-low range is actually 56.86, 57.33. It's a neat, clean range, and based on internals that have matched the break above and the break back below, it's a good spot to be focused on. And then we had run up a little bit after a week after the announcement and kind of hit that 57.60, 57.67 area. So we've been sitting in there until yesterday, where we broke out above. Then today on a retest, which I wrote in my note prior to this retest, that we should see a retest in relative short order of the 5760 range if we expect to move higher for real, which we did see today. And you can see that in that kind of doji kind of candlestick there with the circle on it. So we're working through a range. We have a 5,800-ish top now based on yesterday's high. I don't like internals at this point. I'm not in love with them. They're kind of flat. They're struggling to find direction, which is fine. Net, we came out of a negative into a neutral for a day, and now we're positive on the signal. I'd like to see some more push through 5,800, but when comments come out of the Fed like they did today, people are starting to think, hey, the economy might not be as strong as we thought it was. The Fed story might not be exactly what he said it was because there was more pushback, and jobs are a concern. And and by the way, like we might have cut a little bit too much heading into an election, not political at all, and we want to cut back or at least open up the door that we may not be cutting for the rest of the year because we can't, because inflation will be a killer. If we get that second spike up, which we talked about 2 or 3 weeks ago in a 1970s type move, which as of right now, we are basically in lockstep with that at this current level, it's going to be a killer. It'll be a killer for the economy. It'll be a killer for the market. It's going to be a disaster if that happens. And unfortunately, I feel like we're pushing too far towards letting that happen for reasons outside of the Fed's mandate. I'll leave it there. I want to get to your report. You issued a report in the Brownstone Journal at Real E.J. Antoni on X. It could also be seen at the Brownstone Institute handle on X. This report is phenomenal, along with, and I want to say Peter St. Onge, who wrote the report with you. You co-authored a phenomenal report, and it really digs into inflation, CPI, the methodology, what we're really seeing as far as earnings and household income, that real dollar, what that dollar's worth that we're all bringing in at the end of the day in nominal terms and real terms, what our retirement looks like based on inflation, what GDP looks like, are we really growing or not? I really want to hand it over to you. I'm going to be very quiet, and I would like you to just go through this report, as shocking as that is.
No,
I'd
not
like
too
you
quiet.
go through this report and please run through the methodology, the report, and kind of where we land, because I've read it 4 times and I think it's fantastic. Everyone should be looking at this.
Well, Anthony, I really appreciate you highlighting this, and hopefully people do go and and check this out, because I think it really is important to understand where we are today. We kind of started our analysis here from the perspective of why is it that so many of the American people say that they think we're in recession today. More than half of people in polling say that they think the nation's in recession, even though all the official data says that we're not. And what's really interesting is that even if you get rid of any kind of political component of that question, so you don't say like, has the Biden administration put us in recession, or do you think the Biden economy is in recession? Do you think Biden-Harris policies, blah, blah, blah? No, just strictly, do you think the economy is in recession? And a majority of Americans say yes. So why is that? Well, either the people are completely disconnected from reality or the data is. And it turns out the data is. A lot of that has to do with the fact that although the economy, just measured in dollars, has grown tremendously over the last 5 years, it turns out that most of that is just due to the fact that the dollar is shrinking. I like to say that one of the functions of money is that it's a yardstick. Well, if you shrink the size of a yardstick, take it from 36 down to 30 inches, now it doesn't take 100 of those to cover a football field from end zone to end zone. It takes 120. That's what has happened to our dollar, and that's what is happening in our economy now, and has been, really for 5 years essentially. So what I'm trying to say is that if we measure an economy just in dollars and we don't take account for the fact that the dollar is shrinking, the economy looks like it's growing more than it is. Now, the official economic statistics try to measure inflation, but there's a lot of flaws in that methodology, something we were talking about earlier, right? And unfortunately, methods and methodologies that used to make sense simply don't anymore in a post-pandemic world. And actually, a lot of these problems, Anthony, were present even before like any of the changes related to the pandemic. They were just problems that would rear their heads whenever inflation spiked. So you would think, all right, I want an inflation metric that is going to be particularly accurate during periods of high inflation. No, we have the opposite. We have metrics that get worse the worse inflation is. In other words, as inflation goes faster and faster, these metrics measure it less and less. So really problematic. That's where we are. Okay, so our idea was let's try to correct for those problems. We can break them down into three really basic categories. One is housing. Not only do you have a big lag in terms of when you get a spike and when that spike is finally captured by these inflation metrics, but much of the spike isn't even captured at all. So when rents start going up today, eventually those rent prices, it usually takes about 6 months, but eventually those rent prices will all make their way into a price index like the CPI, the Consumer Price Index. The problem is that housing prices don't. In fact, nowhere in the index do they even look at home prices. They don't look at interest rates. And that's how you get into the situation we have today, where if you look at the CPI, their proxy for home ownership has risen about 22 or so percent since Biden Harris took office. But if you look at home prices and if you look at interest rates, the two main components that go into your monthly mortgage payment, you find that the monthly mortgage payment on a median price home has more than doubled. So our inflation metric there is off by a factor of 5. That's pretty significant for something that makes up a fifth to a quarter of the index. That's huge. So you have housing costs being grossly understated today. You also have different regulatory costs that are being understated because this has to do with something called a hedonic adjustment. And essentially, that just means that when an item or a service, whatever it is, improves in quality, we don't necessarily want to capture all of the increase in price. Because if you buy a car today and it's twice as good as a car from 50 years ago, you don't want that to show up as a doubling in the cost of living. You actually want that to be a net wash. You want that to be a net zero because you're paying twice as much, but you're getting twice as much, right? The problem is when we try to capture the cost of regulation, oftentimes the very people who do the regulating claim that it's going to have all these crazy great benefits. Things like home appliances are a really good example, Anthony. I'm sure tons of our listeners can relate to this, having to do things like pre-wash your dishes today before you put them in your dishwasher because modern dishwashers just suck, as do clothes washers, which is why most people can't fill a clothes washer anymore like you used to be able to. These things aren't allowed to use any water, and so they just don't get your clothes as clean. So unfortunately, though, when you look at the statistics, these things don't show up as cost increases, even though they do cost more today. These appliances cost more than they did 10 or 20 years ago. And even though they do a worse job, they're actually counted as a quality increase because that's what the regulators say. The regulators say you're getting a better quality machine. So people end up paying more for something, but it gets counted as a decrease in inflation, not an increase. Again, it's insane, but that's where we are today. And then lastly, Anthony, you have a lot of things that are what we would say are indirect assessments. These are things like health insurance. So you don't actually want to count the full price of your premiums when you're measuring a cost of living index. The reason for that is because most of your premiums actually go to providing services. They go to paying doctors, they go to paying prescription costs, et cetera. Most of what you pay in premiums, you actually get back. It may not feel that way, I understand, but that's the reality. So what you really only want to count is the part of the premium that's not going to all those services, but that's incredibly difficult to measure. So what these different inflation measures assume essentially is that we can just look at the profits of health insurers, and as that goes up, we can assume it's because they're charging you more in premiums but not providing you more in service. Vice versa, if their profits are going down, we can assume that it's because they are providing you more in services but charging you less in premiums. The problem here is the fact that we're in a situation today where profits are being affected by things like inflation and other costs of doing business going up. And so as those profits at health insurers have gone down, the different inflation metrics have counted that as a reduction in your healthcare premiums, which is insane, but I'm a broken record here, but that's where we are today. So, all right, with all of that context, what we try to do is correct for each of those three different errors within our inflation metrics. And what we arrive at is a situation where since the beginning of 2019, we have essentially seen inflation almost twice what the official metrics say it is on a cumulative basis. So instead of being about 20%, it's almost 40%. That means that most of what we have seen in terms of GDP growth hasn't been GDP growth at all. It has literally just been the dollar shrinking at an incredibly fast rate. And so now it takes many more dollars to cover the same amount of economic activity, just like it takes more yards to cover the same football field if you shrink down that yardstick. And so it turns out that for the latest data we have available, that's the second quarter of this year, the economy is about 2 or 2.5% smaller than it was at the beginning of 2019.
Okay.
So we basically fell into recession at the start of 2022 and have probably been there since with no growth.
And we have that visual. I think we have that chart to toss up of the GDP lack of growth since 2019. So we can toss that up as you're talking.
Yeah, and essentially what you see here in that blue line, that is the tremendous leap in the economy if you just measure it in terms of dollars. But like we were just saying, Anthony, so much of that is simply you're having to take more dollars to measure the exact same thing. And then you can see in orange, that's the government bean counter's attempt to take out all of that inflation. And while you do reduce most of that growth, you don't quite get it down to zero. You can see there we're up, not quite 15%, right, since the start of 2019. But take out all of the actual inflation as we estimate it, and literally all of the growth goes away. And you can see, when does the big downward spike first happen? It happens in 2021. Why? Because at the end of 2021, that's when inflation really starts kicking in. Also, that's when you really start seeing the big appreciation in things like home prices, which again aren't even captured in the official inflation metrics. Again, it sounds insane. People spend a quarter or more of their income on housing, and yet we don't even look at home prices.
That's incredible. That's incredible. Now, one thing as I sit in my seat, I want to talk about, you had gone into a little bit about what this really means for people's, really essentially their take-home dollars and their retirement dollars. So, I think we talked about this last week too. We were talking about how when I and you got out of college, out of school, on Wall Street, my group, we were trying to get to $100,000 a year. That was like your bogey. If you got to six figures, that was the first rung of everything below that. You were getting lunches, getting yelled at, getting screamed at, and all the things, right? But, and that number's gone up to probably $500,000 a year is the bottom rung. And now a lot of that is inflation, because you just can't afford to do what you could have done 20, 25 years ago on 100 grand. Now, that said, we go to the opposite end of the spectrum. We go to the retirees and the baby boomers who are in retirement. And what has this done to their retirement? You had a phenomenal chart up about what they actually have saved because of, or what they don't have saved, but they think they do because of this bout with inflation.
So this is going to be from an upcoming study. Everyone, you're getting a sneak peek. You can say you heard it here first. So essentially, what we're doing here on Policy and Profits is we are previewing for you the results of a study where I look at pension plans and 401ks. And what I saw in looking at pension plans is that although the amount of money in pension plans has risen a little bit, not much, but a little bit relative to where it was at the beginning of 2021. So this is from the first quarter of that year all the way until the third quarter of this year. That's just the most recent data I have available. We see a small nominal increase. But as soon as you adjust it for inflation, you find out that these things have gone down.
Yeah.
Right. At a time when, if you look at most of the models for these pension funds, they thought they were going to continue seeing the typical, like 3 or 4% increase year after year, not only from an increase in contributions, but also from an increase in what was already invested. In other words, the return on investment. Yeah. Unfortunately, though, so many of these pension plans have a lot of investments on the fixed income side. Those things have gotten absolutely crushed over the last several years. It turns out, 2022 was the worst year for bonds in over 100 years. I mean, that's horrific, but that's literally how bad it was given how high interest rates went and also from where they were coming. So not only did we have a big jump in interest rates, right? Okay, 500 basis points is a big hike anytime, but when you're coming off of zero, That's on a on a percentage basis, it's even worse. The other thing is that never before did we have a situation where you had so many trillions of dollars issued. I don't care if it was sovereign debt, municipal debt, even if it was commercial paper, because the Fed kept interest rates so artificially low for so long. Trillions of new debt was issued at these insanely low rates. And so there really was no way to get anything other than on the fixed income side, to get anything other than incredibly low rates of return. Well, fast forward a couple of years, and you have now had three of the worst years in bonds, again, in literally decades. In fact, if you take the last 4 years, right, they cumulatively are the worst, the worst 4 year period of bonds for bonds, again, in over 100 years. And once you realize that, again, a disproportionate amount of pension plans, a disproportionate amount of 401ks are heavily invested on the fixed income side, I mean, these poor folks have gotten crushed. And so, speaking of 401ks, the average 401k balance has increased since the first quarter of 2021. That's true. It has finally recovered. It was down for a while. It's finally back in the black. The problem is once you adjust it for inflation, it's not. And if you're somebody, let's say let's just say $1 million, nice round number. Let's say you wanted to retire with $1 million in assets so that you could live comfortably. Well, that's not enough anymore. The average price faced by retirees for their typical cost of living has increased almost 20% since the first quarter of 2021. So if you thought $1 million was going to be enough for you to retire on, it's not. Now you need 1.2 million. And if you're nearing retirement, guess what? You have to come up with an extra 200 grand. Otherwise, you can't retire. So these poor folks are literally going to have to work almost an extra decade if they were very close to retirement. And if they say, let's say they make the median household income, right? Again, you're looking at working about an extra 10 years before you can actually retire and not have to worry about running out of money.
That's crazy. And the assumption there is, if depending on how much of that million is invested, if your timing is off, timing is everything, right? If your timing is off and you're heading into retirement and there is a cyclical bear where we're down 30 or 40%, which is well within, the realm of possibility. Now you're down, you need an extra 500,000 from those levels in order to retire with that 1.2. So there's a lot at play here. I think the report's phenomenal. This in particular is really disheartening when we talk about, that generation in this country just not being in position to retire the way they should be able to retire, not as a handout, not as a government program, but be able to retire because they've worked, they've saved, they've paid their taxes, raised their children, and they've put money away. But that dollar, that incremental dollar, is not worth what it should be or what it was expected to be worth. And this report, for me, really is a great answer to the question, why does it feel so bad if everyone's saying it's so good? And it really does bring to light how hard this is, what kind of lack of real growth we have, on top of the fact that there's no real growth, but there's this inflationary layer on top that's just making everything, that much harder to afford. So it's really
Right.
it's a multi-pronged problem. And I guess that's why I get frustrated when I sit and I listen to the Fed, or I watch the BLS reports, the economic reports each day, and I hear a comment from Boston today, and it's these yell and forget. I can't even get into yelling. It's not even the thing. I don't. It's just this constant barrage of, it's a rigged game. It is
Yeah.
what it is as far as the data. The data is feeding directly into the market. The market participants are reacting to the data, and we say all the time, my way of technically trading and model-based, rule-based trading shows me where the market is going,
Mm-hmm.
not where I think the market should go. And it is an exercise in mental strength not to veer off of the model calls and step in on the opposite side because I feel like we should be going lower or we shouldn't go higher. And I think that that's going to be the breaking point, right? It's none of this is a problem until it's a problem. And that's when everyone runs for the exit. And I think that that's the day that as an asset manager or an investor or a trader, you kind of keep your eye on and make sure that you can go along and get along and make profits and trade and hold positions and be nimble. But at the end of the day, this will all come to pass. It will reconcile itself in one way or another, and it's not going to be a good day. It'll be a pretty bad recognition phase of the coming bear, and it will happen. The report's phenomenal. I really appreciate your time. I think this is the type of stuff that needs to get out there, and this is what people really need to read and factually see, lay out, quantify exactly what they're feeling, because what we're being told is not what we feel. The people that are saying it are just, really irresponsible, incompetent, or just stupid.
No, Anthony, you're absolutely right, 100%. And you know, before we get back to that level of stupidity, one question for you. When we do these types of analyses, we being, I guess, economists broadly, and we're looking at just macro level data, right? We're looking at things like pension funds, all pension funds in the country, or all 401k accounts. One of the things I've been observing is that it's what I call being overly diversified, where
Mhm.
people are essentially just taking all their retirement money and doing things like, I'll just buy the S&P and I'm just going to dollar cost average it over literally my entire working life.
Yeah.
And so, how does something like that compare the average 401k versus the kind of model that you work with, right? Versus how you run Island Capital Investments. How does that fare versus the average Joe who's, basically just doing what some Joe Schmo financial advisor told him to, essentially, and then he ends up like our numbers say over the last several years, where he's literally seen a negative rate of return after adjusting for inflation.
Yeah, it's a great question, and I think that there's a couple of parts to the answer. The first part to the answer is, if you're sitting in the S&P, let's just say you buy the SPYs, you're in that ETF for a very low cost, and you are at the will of the market over time. And this is the constant mantra, and it's true. Over time, prices will increase, your account will get larger, you'll be paid dividends, and prices will appreciate. What I do differently is I'm directionally agnostic. Within those bigger moves, I may have some things that I'm holding much longer term to take advantage of larger moves, but I'm more intermediate in scope and in view, meaning whether the market's going up, I'm going to catch a piece of that move up. As the market comes in, I may make money on the way down as well, because I can be long and short. I can be flat. I have a lot of flexibility in my mandate and how I run the fund. And I'm running the fund based on a model that I've used for almost 20 years now. So I know that within that model, there is some extra volatility, but the return for that volatility is you're able to make money on both sides. And very importantly, the timing of the market is such that if I'm going to step away where I see or think I see a big drawdown coming, I can do that. Whereas if you're stuck in a pension fund or you're stuck in the SPYs and you're not touching it, but in 12 months from now you want to retire, if you're not managing or you don't have anyone managing that money to a point where you're actually marking risk and risk managing, you could come out and at the end of that year you had $1 million, now you have 750,000 or 700,000 because you didn't make a move and you weren't able to adjust. So I think the optionality I have at Island Capital is huge. The ability to make money on the way up and on the way down, and kind of reduce exposure or reverse exposure, is kind of what makes the strategy here a little different. I'm also not a massive fund. I have a good amount of assets. I'll be taking assets on again, an additional tranche in January of 26. But right now it gives me the ability, even though I'm scalable, it gives me the ability to be very nimble and to be long, flat, short, where a lot of funds can't. They don't have that in their mandate. They're stuck long. People are stuck long, or they're just too large to actually make the moves around the market. Another side note is I do not trade on any fundamental inputs. So whereas that long short fundamental analyst has been cleaned up over the past 10 years, it's extremely hard to be in
Mm-hmm.
that game and to make money consistently. A lot of the capital has gone to these large multi-strats like the Millenniums, like the Citadels, where that money can be dispersed into multiple strategies within that fund, almost like how the mom and pop shops went away and everybody goes to Walmart. Same type of idea, right? You can go in, you can buy
Yeah.
apples, You can buy, your underwear, and then you can go down and buy a bike for your kid on the way out, and everybody's happy. You go home and you're good. I think that those large multi-strats run phenomenally well. I have some very close friends, for some very longtime friends at these funds. And I've traded for them for many years. When I was on the sell side. So their strategies, their model works. There's no question. If you size down and you look at a smaller fund, I feel like the technical strategy that I run, the rule-based strategy that I run away from fundamentals, provides an opportunity to be a little more nimble and not get hurt on those big drawdowns, but be able to participate on the moves up. And that's kind of where I want to live.
So in other words, you're not stupid.
I'm not stupid. I'm not. Wait, is that a trick question?
No, it's a segue. It wasn't the cleanest segue, but it's a segue, right?
What do you got?
It's a segue to a man who knows stupidity when he sees it. Because let's be honest, stupidity can not only ruin you financially, it can ruin your country. So we don't want stupidity. So without further ado, the man who, again, knows stupidity when he sees it.
You see, that's the real threat to democracy, stupid people. That's the threat. Our biggest threat to democracy is stupid people.
That's a close. I don't have anything to say.
Antoni, it's been fun, my man, as always.
Thank you, sir.
Have a great weekend. Spend it with the ones you love.
You as well. Thank you, buddy. Talk to you next week.